Hi, everybody. This is Alex Fensky, the lead agent for the Chicago Southland Homes team here at Keller Williams Elite, and I wanted to bring you your June housing market update. You're probably hearing at this point, if you're listening to news or seeing articles, or you have any friends that are doing things in the real estate market, you're probably hearing how things are changing. It's true that things are changing, though. Anytime things are changing, I'm always seeking the truth rather than just the stories that come up, because one person's experience doesn't necessarily tell the story of the entire marketplace. And I do hear a lot of conversations right now where people are saying things are this way, things are that way, and they can't be both ways. So which way are they? Well, we're going to go into it here. I've got some important real estate market metrics that tell us what's happening right now, and some economic things that are going on that explain a bit of what's happening now and what to expect in the future. And lastly, we'll end with just telling you, broadly speaking, what sellers and buyers might want to be thinking about right now, though, of course, that comes down to you individually and your personal circumstances. So always comment, message us, drop us an email or a phone call, and that way we can help you with your individual set of circumstances, goals, and plans. With that said, let's dig into it. The number one market metric that I start with is the number of new listings, the number of new sellers that listed a home in our multiple listing service during the month of May. And that number was down 10% compared to May of a year ago. That continues a trend that we've been seeing this entire year. In fact, year to date, from January through May this year compared to last year, the number of new listings is down 12%. That's been very consistent here throughout the first half of the year. Similarly, the number of pending contracts, which more so measures buyers and buyer demand, is down 13% compared to May of last year. Now, May of last year was a special time. It was particularly outrageous. It was one of the peak months of this whole COVID-era housing boom that we've been going through. And prices that time were skyrocketing because of intense competition. And so the number of pending contracts is down 13.6% compared to that. Well, that's a tough comparison to make. I'll point out a couple things. Number one, that pretty much, it roughly matches the drop in supply, the drop in the number of sellers who listed a home, because that was down by a similar amount. So the number of sellers went down, the number of buyers went down about the same. It's also still identical to the number of pending contracts we had in May of 2018 and 19. So May of 2020, that was an exception. That was an anomaly. It was early COVID times. May of 21 was also an exception because that was in the height of the rage. If we go back before those couple of years, our contracts pending this May were the same as 2018 and 19. I mean, within a couple hundred throughout our entire northeastern Illinois multiple listing service. So pending contracts are roughly what we would consider to be normal. Crazy to accuse anything of being normal these days, but it's about normal. In terms of inventory, the number of homes that are available for sale right now, that's not normal. Inventory always increases throughout the spring. It bottoms out in the dead of winter, and then it goes up all the way through the spring and summer before it starts to go back down. Our seasonal patterns are very consistent. So normally from April to May, inventory increases by between 3 to 8%, somewhere in that window. Right now, my numbers are showing that we increased only about 2.75%. But after we get adjusted numbers a little bit later, that'll probably land in that 3% neighborhood. So inventory increased from April to May, a very normal amount. What isn't normal about it, though, is it's by far the lowest inventory May on record. It's down even 26% compared to May of last year. So there's actually, even compared to May of 21, for every 100 homes that were available in our MLS then, there's only 74 available today. So inventory is very, very much a record low, though it's ticking up just the tiniest of bits. Supply, and when I say supply, I don't mean the number of sellers. If you're an economics person, we talk about supply and demand. This is our weird real estate language. The number of months of supply. So that means if buyers kept buying at the current pace, based on the number of available homes, how many months would it take for buyers at this pace to buy up all the available homes? 6 months of supply is a balanced market. Longer than that, any more than that is a buyer's market. Anything less than that is a seller's market. Well, starting in 6 months ago in December, we hit rock bottom in terms of months of supply We were around 1.2 months throughout our whole MLS, which is insane and numbers we've never seen before. And with all the changes in the marketplace, it has risen all the way up to 1.4. So 1.2 months to 1.4 months of housing supply. Barely a drop in the bucket of getting back to anything that's somewhat close to normal. And so, if you're hearing stories about how it's harder to sell a house now and all this stuff, I think a lot of that might be hype. We have 1.4 months of housing supply. That's very, very, very much a seller's market. We have a very long way to go before we get back to a balanced market, let alone a buyer's market, which is nowhere in sight. Let's talk about prices, though, because prices, this is what has changed quite a lot. Prices have been going up at outrageously high annual appreciation rates, especially last spring was really out of hand. But for pricing from April to May, which normally goes up between 1% and 2%, it remained flat. So our pricing really leveled off. In fact, if you take a 12-month rolling average, which we could say adjust for seasonality because it includes all the seasons when you do a 12-month average, our 12-month rolling averages have been pretty flat for the last 3 months, which just goes back to when mortgage rates skyrocketed. And that's what's going on here is the cost of money is driving the flattening of pricing, not demand and supply, because we just talked about how it's a ridiculous seller's market, but the cost of money has come up so much that relative to where it was, that it's caused a lot of people to put the brakes on throwing their extra 30, 40, 50 grand over list price or whatever it was they were doing. So that's purely because of the cost of money. Speaking of which, what are mortgage rates doing right now? Today's average is about 5.09% on the 30-year fixed rate mortgage. That's off its peak a little bit. It peaked about a month ago, early May, at 5.30%. It's probably going to go up more than it's going to go down in the future, and I'll explain why in a moment. But again, when I talk about mortgage rates skyrocketing and all this all sounds very dramatic, but historically speaking, these are still below average mortgage rates. When you take long-term averages of mortgage borrowing, you end up with numbers around 8% or even higher. So they're high compared to what they've been for a long time, but historically speaking, mortgage rates are fine. They're actually still pretty low. But we have short memories, so we tend to forget what mortgage rates were. All we remember is when they were 2 point something. So let's talk about economic conditions. I won't go super deep into the nerd stuff here. Maybe I'll do a whole separate session about the bond market and the mortgage-backed security market. It has a very, very lot to do with what's going on in housing right now. So it's very important, but I'll give you the summary here. The Federal Reserve, during COVID, in order to stimulate the economy, they started buying massive amounts of assets, which injected cash into the economy and created tight markets for those assets. Those two assets primarily that they were doing this with were treasury bills, which are bonds issued by the federal government, and mortgage-backed securities, which are when a bank writes a loan and then they package it up with a zillion other loans and they sell it to Fannie Mae, Freddie Mac, or some other entity. Those are mortgage-backed securities. Now, throughout COVID, the Fed bought about $3 trillion of each of those types of assets. And mortgage-backed securities and the bond market directly impact mortgage rates. All the news about the federal funds target rate, their overnight borrowing rate, does not directly affect mortgage rates. It indirectly has influence on them. But mortgage-backed securities and treasury bonds have a direct effect on mortgage rates. The Fed injected $3 trillion into each of those over the course of the last 2 years. What's special about this is that this week, just this past week, they began selling those off. So while mortgage rates may have dipped a little bit, when they go and sell, they're selling now about 95 or 96 billion dollars, 95 or 96 billion dollars of these two assets back into the market every month. And that's the current pace. That means they're sucking that amount of cash out of the market, and they're dumping these programs, these products onto the market, which changes the pricing of those products because now there's a bunch more of them available. So that means mortgage rates going up. So we expect that to happen more. One quick aside, not doing gloom and doom, but there's an important indicator called the 2-10 yield curve in relation to Treasury bills, and it hasn't been wrong yet in terms of predicting when an economic recession will happen. within about 18 months. That yield curve crossed and inverted very briefly in April. It may indicate that based on all the information at hand, we're looking at a probable economic recession sometime probably after the second quarter of 23. But all that depends on what the Federal Reserve does. Now, they're meeting again next week, June 13th, 14th, I believe. The Open Market Committee meets and will decide what to do with the federal funds target rate, the overnight bank borrowing rate. Originally, they were going to raise it by another 3/4 of a point, 75 basis points. That really sent the markets into a turmoil. Everyone was freaking out. It looks like they're probably going to do it by half point. See, if they raise that too fast, what will end up happening is they'll drive the economy sooner and harder into recession. Everyone's hoping for what we call a soft landing, where they're able to sort of judge where we're at a little bit better and not quite send us into a recession or not a bad one by increasing that rate too rapidly. So they're trying to find the balance there. We'll find out more about that next week. So lastly, what do you do? Right? Here's a bunch of nerd information that I love. Like, what does it mean for you? Well, number one, let's just summarize what has changed and what hasn't. So number one, what has changed, the number of transactions in the real estate market has changed. It's down about 10%, 15%, give or take. So it changes things a little bit, but that's not a dramatic change. What really has changed is prices. As real estate owners, if you own real estate, we're not looking at these crazy high double-digit annual appreciation rates anymore. What we're probably looking at is annualized mid-single digits, 5, 7%, 8% maybe on the high end in terms of annual appreciation. So we had a nice ride. I think it's going to be a bit back to normal in terms of pricing. What hasn't changed? The balance between sellers and buyers in the market. I told you, housing supply is the best measure of that, and we've gone from 1.2 to 1.4 months. There's still way more buyers than sellers competing for their scarcely available listings. They just don't have all the extra cash to throw at it anymore. So it creates a bit of an interesting scenario. What should you do? Sellers, I want you to know you've probably captured the bulk of the massive appreciation that we're going to see through this market cycle. So don't expect that's going to continue. And you're still in a good position to sell because it's still very much a seller's market. Now, over time, that's going to level out. It won't stay that way permanently. So if you look over the longer term, over a time scale of years, that will change. I don't think it's going to change super rapidly. So I think you're still in a good position. If you'd like to sell today, or you'd like to sell, next month or 2 months from now, we can be pretty confident that conditions are going to remain similar to how they are today. That's what we've seen right now. And lastly, buyers. What should buyers do? As a buyer, like if I'm looking at buying, I would consider that even though the rate of price increases is scaled down, it's still positive. It's still mid to high single digits. And even though mortgage rates have backed off by a tiny bit off their peak, the things that are happening in terms of monetary policy are probably going to continue pushing them back up over the long term, and they're probably going to go more up than they do down. So if I'm a buyer, a house that I buy today is going to cost me less money than a house I buy 3 or 6 or 9 months from now. Now, it might ultimately be easier to participate in the market a year from now. Supply may have approached closer to a balanced market at that point. But at that point, prices will be higher and rates will be higher. So it's actually still going to cost you more money. So it may be worth it to put up the good fight now if you really focused on buying. And you'll probably save money over the long term by doing so. So go ahead and feel free to email me, Alex at Chicago Southland Homes. Give me a ring at the office, 708-808-0220. Or just comment or message on our Facebook page, LinkedIn, YouTube, whatever it is, wherever you're watching this. And let us know what you're doing, what you're up to. And we'll be happy to help out. Thank you very much.